Well, hello everyone, and welcome to this presentation. Let me know if you can hear me okay. There's a chat button on your on the panel there. Let me know if you can hear me fine, so I'll know that everything is fine, that you can hear me. I had a few technical issues to get started into this, so just want to make sure everything is okay. Can you hear me fine? If you can let me know through the chat button there, type in your message, let me know what's going on, that you can hear me, that would be great. Well, I guess we're fine. Everything is okay. Everyone can hear me. Welcome, and welcome to this presentation. And this presentation is brought to you by bizbank.com. We are the SBA loan expert. We specialize in helping small and mid-sized business owners finance their dreams with smart financing and government contracting. So today in this presentation, we're going to talk about how to maximize your credit and how to use your credit to improve your chances of qualifying for higher than usual business financing. So if anyone has a question, feel free through the chat to let me know, and we're going to get started now. So again, welcome. In this presentation, I'm basically going to talk to you about how to improve your credit in as low as, as little as 90 days, so you can qualify for higher than usual loan amounts. Well, the first thing about this, and the reason why I decided to do this, is because I see so many business owners that come to us for their financing, and they end up not being approved or end up being offered higher than normal interest rate. And usually it's very disappointing when you see a business owner that's deserving, that's working hard, trying to build their business, and they're at that point where they need to grow, and the capital they need to grow is just not available to them because of some past credit issue. So without further ado, let's get started. If you can hear me fine, let me know. If you're having any problems, also let me know, so I can adjust my voice and make sure everyone can hear me fine. Okay, so I'm hoping everyone can hear me, and we're going to get started. Okay, so the first thing that you want to know is that most Americans, about 83%, that's about 249 million Americans, have an error on their credit report. And chances are you are an American, or if you're a Canadian, it's the same issue. The same companies are the same credit companies are the same credit bureaus that also have subsidiaries or divisions in Canada. So enough about that. So let's talk about, we all know that with bad credit, you will pay high interest for your home, high interest for your credit cards, and as a business owner, often that puts you out of contention for business financing or getting the best rates you can possibly get. And that's this is often a problem for a lot of business owners. So why should you care, and why is it important? Well, what you want to know is that even a point difference in your credit score can mean a big difference in what kind of approval you're going to get from the credit company. Having a 719 FICO score is so much more different than having a 720 FICO score. That puts you in a completely different category of approvals, just that one point. And usually when you're applying for credit cards, for instance, you're approved by an automated system, and the automated system is simply looking at the number. It's not looking at your credit history in depth. It's looking at certain items on your credit history, but mostly looking at the number. And that can mean a difference between being approved for an SBA loan, for instance, at 6%, or getting a merchant advance, cash advance loan that go up to 89%. So what do most people think? Most people think that paying their bills on time is the only way to maintain good credit. But I'm going to unveil to you that there are other factors that are just as equally as important as making your payments on time. And the truth is that, a good payment history only makes up about 33% of your credit score. So in this presentation, I will show you an effective way to increase your credit score and save you money. So what are the factors that affect your credit score? One is how much credit you have available to you versus how much credit you've used. I'll give you a quick example. If you have a credit card that's, say, a $10,000 credit card and you've charged more than $5,000 on it, that credit card is now affecting your credit score in a major way. So number two, the number of inquiries on your credit report. You want to keep your inquiries under 2 inquiries per year, no more than 2 inquiries per year. And that number, we got that number from FICO directly. So if you go to myfico.com and look for facts about your credit report, and you will find that that's the highest percentage of people that have a credit score of 720 or above have no more than 2 inquiries on their credit reports per given year. So number 3, the number of credit lines you have available to you. You would like to keep this number at about 3 to 5, no more than 5, to have a high credit score. Well, the types of credit available to you. That's number 4. Number 5, your debt to income ratio, or when it comes to credit, it's really your debt to credit ratio. So let's keep in mind at this point that, foreclosures and bankruptcy tend to stay on your credit for 10 years. But there's a way to handle that, where you can actually have them removed from your credit. So how much you have to have available and how much you have used in your credit, how much does that affect your credit? So that's factor number 1. Having a higher percentage of unused credit available gives you a higher score. And if you use all the credit available to you or max out your credit at any time, that is affecting you negatively. In other words, having more credit actually helps you. When you have more credit available than you not. So if you have a $10,000 line of credit, it looks better on you to having $8,000 of it available versus someone who has $5,000 available when $5,000 is being used. So your debt to credit ratio is the amount of money owed versus the amount of money available in your credit line. So this affects your credit. So you want to keep that below. At a recent research or looking at MyFICO, which is the company that actually issues the most used credit score in the nation, is in the recent research you find out that people that have a credit score of 720 or above maintain on average a 20% balance on their credit card, no more than 20%. So that's a good tip for you. So how do you fix this issue? When you have your credit card maxed out or nearly maxed out, you want to call your creditors and at least every 6 months ask for a credit limits increase. You most likely are not going to be talking to a person in charge, but also let me just remind you of this. You also may want to ask for a lower interest rate. So the less amount you pay in interest, when you have a higher balance, the more affordable it is. So the first person you're going to talk to is not going to be a decision maker or an authority, someone in charge that may, actually lower your interest rate. Sometimes you can ask for a manager if they can do so, but ask for a promotion. Do they have any promotions available that are available to you at the time? If they do, make sure that they let you know of all the promotions, and let them know sometimes that you're considering switching company. And if they will offer you a better deal than what you're being offered now, that you will switch. So that's one way to improve your credit score. and that can improve your credit score dramatically. Okay, so, another tip that I'd like to share with you, be aware of your spending. If you're running your credit cards or you're maxing your credit cards, pay them off. Paying your credit cards off every month after you've maxed them affects you, because while your credit cards are maxed out, your credit score is at its lowest. Most people think that if I pay my credit, I use a credit card, say I have a say $100,000 credit card that I use every month. At the end of the month, I write a check. That actually does not look good for you on your credit cards, because you look like a very high risk. If something goes wrong 1 month and you're not able to pay that, you are basically in a situation when you have this credit card maxed out, the payments will be higher. So, a lot of people think that that's the way to go, and that is not the way to go, okay? And most of the time, if your credit is poor, your limits are nearly maxed out, or, you're more likely not to be approved. I've actually recently had a client or customer or someone who contacted us for a loan, and their credit score was nearly maxed out on all their credits. I mean, they were nearly maxed out, even though this person had a still higher score than usual. They were still turned down because they just looked as a higher than normal risk. So important to keep that in mind. And if you plan to go look for a loan, you want to pay those balances down before you actually apply. Don't just take a chance and say, okay, I have a score, let me apply. They will accept me. When when you max out on most of your credit lines, you look like a higher than normal risk. So you don't want to do that. And the other thing you want to do to improve your credit score is reduce the number of inquiries. And also, you want to look at the types of inquiries on your credit. So what is an inquiry? An inquiry shows up when someone pulls a credit. The more inquiries you have in your credit, the lower your credit score. Everyone knows that, I suppose. But there are two types of inquiries. You have your hard inquiries. These are the inquiries that show up on your credit when you've asked someone to extend credit to you. Too many of these can lower your FICO score dramatically. According to, I've actually measured this. Your credit score will drop by 8 to 10 points every time an inquiry shows up on your credit. Again, as we talked about previously, you would like to keep a minimum of only 2 inquiries on your credit, no more than 2. So the other type of inquiries, then you may ask the question, well, if I can't pull inquiries, how would I know, what's on my credit? Well, there is a type of inquiry that does not affect you, and that is what's called a soft inquiry. This means you or someone is taking a peek at your credit. This is what happens when you go to, myfico.com or any of those companies that allow you to look at your credit. When you do that, that's called a soft inquiry. So it does not affect your credit because it's either yourself looking to take a peek at your credit, or a company, maybe Capital One, maybe looking at your credit to extend credit to you, make you an offer about a new credit card that they're offering. I'm sorry, I had to drink something there. This will basically not show up on your credit. So soft inquiries are not bad. Hard inquiry, not good for you. So tip number 3 and number 4, don't overreach. Don't apply for unnecessary credit cards, such as department stores. Most people do this when they walk into Macy's or any other department stores, for instance. They will, when there's a sale going on, you can get 20% off when you apply and approve for their credit cards. Keep in mind that most department store credit cards start at 22%, and they can go higher than that. So those cards are not beneficial for you. They put unnecessary inquiries on your credit. You're better off applying for, let's say, you know, Barclays card. Barclays offering, you know, a 0% interest rate when you transfer your balances to them. You can apply for cards like that and maybe transfer a balance that you have on a card that's, say, you know, $2,000 balance, and you apply it and you get approved for a $10,000 card. You can transfer that balance over there, but you know, beware of department store credit cards. They're not beneficial for you. Don't ask too much for credit. So don't go out on, you know, on a spree, credit card spree, when you find out that you have a high score and you start applying everywhere. Those hard inquiries will be taking a hit on your credit, and they take about 2 years to come off of your credit. Although there are methods that can be used that you can, where you can have these inquiries off of your credit score. Oftentimes you can, you know, go to your credit union and get pre-approved for a car loan, and you walk into a dealership and they're saying, well, we still have to pre-qualify you. And they run your credit even though you have a check in hand that's saying you've been pre-approved. You can pass, you know, you can give them a check from the credit bureau, the credit union. They'll still run your credit. Those inquiries are they're inquiries that you can have removed off of your credit because you did not technically authorize those inquiries. So just be aware of not adding too many inquiries to your credit. Well, the next thing that you can do to improve your credit score is the number of credit lines you have available on you. Having 3 to 5 credit, you know, lines of credit is ideal. You don't want to have any more than that. I would say the mixture should be somewhere: a mortgage loan, a car loans, maybe 3 credit cards, and that's, you know, that's about ideal. You don't want to do any more than that. So tip number 6, keep a small outstanding balance. Having a 0 balance on all your credit cards at all times can actually lower your score due to lack of utilization. You want to keep in mind that when a credit company gives you a line of credit, that's money that they've set aside that they can't use, so to speak. I mean, it's technically, you know, it's kind of like they put aside money for you. And when you're not using this, it says 2 things about you. One is either you're not capable of managing risk or managing credit, or 2, that you don't need the credit. So there's really not, the history is not working on your favor here. The credit history works on your favor when you have balances, you're paying them down. This shows this is a responsible borrower. This looks good, and this is actually one of the factors that's being used to calculate your scores on a daily basis. So to not use a credit card or keep low balances does not help your credit score. So the types of credit available to you, there are, you know, several different types of credit history that helps your credit. You know, a home loan, for instance, we consider a home loan is like kind of the Mac Daddy of loans or types of credit you want to have. So you want to have a home loan, you want to have a car loan, and you want to have some credit cards, maybe 3: a Visa, a MasterCard, or American Express or Discover, whichever one you discover, whichever one works for you. But you don't want to have any more than that. Any more than that, it starts becoming, you know, less manageable when you run into issues, when you run into problems. Installment loans. Well, an installment loan is a loan. You want to have an installment loan, at least one installment loan on your credit. It's a car loan or a jewelry loan, and you want to keep those lines active. You don't want to close them because you paid off that watch, or you paid off that ring that you bought your wife, or that bracelet that you bought your husband. You don't want to close that line. A closed line, that history automatically stops being a factor on your credit. So closing a line of credit is not beneficial for you. You don't want to do that, so pay attention to that. Revolving lines of credit. Revolving lines of credit are the least, well, I would say the least favorable to you as opposed to what kind of balance you have on them. These loans have a payment that fluctuates. Your credit cards or your home equity line of credit, 1 month it'll be $20,000, so your payment is higher when the other. It could be $10,000, it could be $5,000 or $1,000. So these fluctuate. So they're as a factor of risk. The credit company look at this a lot more, a little more. They're a little stricter because of the fact that these payments can fluctuate. You can have a line of credit of $100,000, so you can at any given time borrow $100,000. So that's looked at a little stricter than your installment loans, your home loans, your car loans, because that payment is clear. They know how much you're going to be paying every month, so everyone is clear on the payment. So so that we got that. Again, if you can't hear me or you're having issues hearing me, please let me know so I can make sure I adjust my voice enough so you can hear me. Mortgage loans are the best loans to have, the best lines of credit to have on your credit. As we all know, they're backed by real estate, so they actually count very well. Missing a payment on your mortgage loan can affect your credit by 80 to 100 points. So one late on your mortgage payment can affect your credit by 80 to 100 points. And that also depends. The higher your credit score, the harsher the credit factoring or the credit risk system will affect you. In a sense, when you have say a 780 FICO score and you miss a payment, you're more likely to be hit with a 100-point loss on your credit score than a person with the 680 that might lose 60 to 80 points. So the higher your credit score, the harsher your missed payments will be on your score. So keep in mind that your debt-to-income ratio, I really don't, the people, in the credit industry, they usually talk about debt-to-income ratio, but that really affects you more when you're making large purchases, like your car, your home. For the most part, they are considered, but not as much when you're looking at like credit cards. So, we know what's your debt-to-income ratio. For $1 you earn is a percentage of dollar that is committed to payments towards any and every loan that you have. The more money you must pay towards loan payments, the lower your score may go. It really doesn't affect you that much because they don't know what your income is at all times. But once it's disclosed and it's been added onto it's been factored into your credit, it will affect you. And so you really want to keep in mind, what you really want to pay attention to is your debt to credit ratio. So if you have available to you $10,000, keep in mind you want to owe no more than $2,000 on that credit cards. So the question then is, how do I increase my credit score? The most important thing you can do immediately to increase your credit score is to go and pull your credit and review it throughout. Be thoroughly review your credit for any errors, no matter how small, and get them corrected. Now let me talk about what type of errors you can get corrected. A lot of times people do not realize having way too many addresses on your credit is being a factor on your credit. It's affecting you. Look at your credit report. Look at the addresses being reported there. Some of those addresses are not yours. You've never lived there. You lived there a long time ago. Try to get those addresses off of your credit, and phone numbers on your credit that no longer belongs to you, because they're going to check. A creditor will check those numbers and see the numbers are turned off. And those all factors are being used against you without you knowing. So no matter how small, the misspelling of your name, the incorrect date of birth, maybe you have a brother or a sister with a similar, very close name. I've seen this recently, where two sisters, one sister's credit was being negative, actually credit was being reported on another, unbeknownst to her, that she was actually suffering from bad credit, but that wasn't his history that was being used. It was her sister's history. She just assumed, as we all do sometimes, not wanting to look at our credit because we're just afraid of what we'll see, and sometimes it could be worse than we thought because some of the items on our credit are not ours. So look at your credit thoroughly and look at all the errors available. The one company that I recommend to pull your credit from is myfico.com. Now, I do not get paid for myfico.com for this. The reason being, myfico.com, FICO is actually a Fair Isaac company, is actually the company that invented the credit risk factor system that we use today. And a lot of the other, like Karma, Credit Karma, all the other companies, they use what they call a Vantage score. Those scores are not equal to what MyFICO score uses. You know, so the top 100 lenders in the country, maybe even more, and all types of whether it's been credit cards or mortgages. In fact, mortgage companies or banks that are considering mortgages only use FICO scores. So if you're looking at your credit at another one of these companies, and you're looking at your credit score being 680, keep in mind your actual score is about 30 to 50 points lower than what you see on most of these free credit websites. MyFICO will give you the FICO score. It may not be the exact same FICO scores that your mortgage broker will see, or your car lender, your car loan company will see, or your credit card company. You have different types of FICO scores. Just like you have, you may have Windows 5 or Windows 6 or Windows 8 now. They have those different, so different companies use a different software, so to speak, as far as FICO is concerned. So now, FICO, there's a FICO 8. So keep in mind that you have a different score when you have a FICO score for insurance. You have a FICO score for renting, for cars. Your FICO score is not the same all the time. You have multiple different FICO scores that are being used. You have a bank score. You have multiple scores. So but you go to MyFICO score. They have the most accurate score that will be closer to what you will get from your mortgage broker, your car loan company or credit union, or your credit cards company. So myfico.com. Another source where you can pull your credit from is annualcreditreport.com. They charge for the score. So it'll be like $7.95. Myfico.com is only $4.95 for the scores. You want to pull all three credit bureaus, the major ones. There are different other credit bureaus that no one really talks about, but they're major companies because most major lenders will use TransUnion, Equifax, and Experian, and check for errors, and then just go to work. What you want to check for. Again, I talked about this before. All your home addresses, employers' addresses are correct. The employers' names are correct. Your name is spelled correctly. Current businesses, employees are listed. Duplicate accounts. Sometimes you can have the same accounts being reported twice. You might think it's a benefit, but it's not. It's really affecting your score. So you want to have the duplicates eliminated from your credit score. Is your payment history accurate? Someone may be reporting you late 1 month when you know you made your payment on time, and they didn't show it on you. They didn't report it on time, so you want to go ahead and make sure you correct this. One way to correct this is you can call your bank and see the date that the check was cleared out of your bank account, that you paid, that when you made a payment, and if that payment was not posted to your account on time and they reported you late, you can have this account corrected. Okay, so keep that in mind. Again, all accounts are listed, open, closed. All the all your credit accounts must be listed. Exactly with everything, the date the account was open, the balance owed, the last time you made a payment. There shouldn't be any item missing that explains clearly what the credit is, what the credit line is about. Okay, so sometimes you have business lines of credit that are showing up on your personal credit. Make sure that most business owners suffer from this. And what that does is generally when you borrow from your business, you're investing in your business. So you're not looking at it as a personal expense, like you're maxing out your business credit lines. And the business credit is not looked at by, the risk on business credit is not the same as on personal credit. So if your business credit line is showing up on your personal credit, is being assessed differently, that is affecting your personal credit score. You may want to call your business credit and let them know that they should report that to your business credit. You may want to call Dun & Bradstreet, Equifax business, so you may want to call Experian business and have those business lines removed from your personal credit, because you may say, well, how is that going to affect me? Well, when you're looking at, say, getting a mortgage, and the mortgage lender is looking to see that you have 28% of your income is available to take care of this mortgage, for instance. There are different ratios, so different types of loans you get. But if you have your business credit showing up on your personal credit, it is affecting you. And you might be denied for a home loan, for instance, because you owe too much. Whereas if that line of credit is being paid by the business, let it show on your business credit and have the business pay for that, not affecting you personally. We can talk more about that, or I can have maybe another webinar where I'm going to talk about that. That's something that you want to keep in mind. Your available limits listed accurately. Sometimes you may have a card that's been increased to, say, from 5,000 to 8,000 to 10,000, and if that's not showing up on your credit, then you go and maybe charge $3,000 or $5,000 on that card. Now you look like you maxed that card out. That is affecting your credit score. These are things you can do. It does not require you to be an expert credit repair person to do these things. You can do this on your own and call each one of these credit companies. And if you run into a roadblock and maybe not, you can't move it forward, or someone, look at the expert. Look at companies with good Better Business Bureau listing that been doing their business. They've been handling credit repair for years, and there are a lot of great credit repair companies out there. They can actually help you get these items fixed. And if you need some recommendations, you can always give me a call, and I can help you with that. So, so what are you looking for? We talked about that. I went over this. These accounts should be listing the following: high balance, the most you ever owed on that card, your current balance, how much you owe currently, your current limits, how much your maximum you can borrow. You want to make sure these things are in line. So once you have these items fixed and inaccuracies have been removed, your credit score will be improved. Contact the credit bureau via mail, phone, on the internet to make them aware of the error and ask them to correct it. Why would you do that? The Fair Credit Reporting Act states that if there is any item inserted on your credit that is reported in error, there's an error, there's missing information. In fact, that item on your credit can be removed, and if you decide so, and never to be inserted again. Okay, so this is important. You may want, why would they do that? Well, like I said before at the beginning of this workshop or webinar, that 80% of credit reports in the U.S. contain an error. So there's a big chance, there's a very, very big chance that your credit does have an error or two. Recently, I was working with a client, that he went out and actually disputed items on his credit himself, and he got a letter from the credit bureau saying that his dispute was frivolous, and he sent another letter based on the advice that I gave him, and this time they didn't respond, and then I have a system that I use for some of my clients, and we sent another letter 15 days later that they didn't respond on time, and this is basically they're not following the law, the Fair Credit Reporting Act, and for that reason they were able to remove all of his negative items. All the negative items on his credit were removed. So pay attention to that. So let's talk about delinquent account. If your credit isn't great, you have outstanding balance in collection. Actually, collections are a good thing for you. Okay, so I'm going to explain why. You don't want to simply pay off if you have an IRM collection, or $10,000 in collection. You don't want to just go and pay that, because once you pay that, you actually made that item current again. It's going to hit your credit even worse than it did, because when a negative item starts getting older and older in your credit report, it's actually affecting you lesser and less. When you pay that, you bring that current, you actually make the credit score credit score system, the risk score system, calculate that factor that into your current credit now, and that will affect you even worse. So instead, what you want to do is get on the phone, call the collection company, negotiate before you pay anything. You'll be surprised at what kind of offer you can get, and I'll tell you the reason why in just a little bit. See if the creditor will let you pay a smaller balance than that's owed. This goes for judgments. You can call the attorney's office. You can call anybody that's reporting you, or even the medical collections, any collections, whether it's a car that was repossessed, whatever it is. If you are currently making money, your financial situation is better, you just don't have the credit, you can call and ask if you will pay off a smaller percentage of the amount owed. What could happen? Many times, collection companies buy these debts at sometimes 5 cents on a dollar, 10 cents on a dollar, or 30 cents on a dollar maximum. If you offer them, say, 50% less than what you owe, more time than not, they would take it. And sometimes they would even take a 15%. If they, as long as they're making a profit, they don't care, right? So this is a big secret. If you have a lot of collections, if you're currently making money to where you can dedicate a certain amount, you can call. And here's the secret. This is a big one right here, okay? Before you make that payment, once you have an agreement, right, if you make a payment of, say, 10% or 15% of the amount owed, ask them for a letter of deletion. There's two reasons why they want to do this. First, they haven't collected. Chances are they might never collect. They've already made an investment. They made an investment in buying this account from the original creditor to them. So they spent some money. They want a return on their investment. The shorter, the quicker they can get that return on investment, the faster, the better it is for them, right? You run a business. You're a business owner. If you're not, you're an entrepreneur, or you at least understand this. This makes sense to you. If that's the case, they will accept lower than what you owe, the amount lower than what you owe. If you ask them for a letter of deletion, they'll send you a letter that says that this item was inserted into so-and-so credit erroneously. And when you receive that letter, you send it to all 3 credit bureaus. That item gets to be deleted off your credit. You can actually go negotiate all your collection companies, all the collections, and start knocking them off your credit one by one, and have all of these items removed from your credit, and you now have a clean credit history. Now, we talked about why you want to ask. That's the vital things. If you don't ask for a letter of deletion before you pay off the debt, that account will continue to show up as a negative item, And you don't want them to say, oh, we're going to report it as settled, or a statement says it's just paid in full. This is not in your best interest. If the item is negatively affecting your credit score, if there's no history on that item, the collections are not helping you at all. Because what happens before an item goes into collection, let's say, for instance, you had it for 2 years on your credit. Let's say it was a car. You had it for 2 years on your credit, and then on the 3rd year, something happens. So you have that item listed originally with the 2-year payment history. When it goes into collection, the collections just shows you have a collections and then now you haven't paid. Once you have that off of your credit, you will increase your credit score immediately, okay? Don't want to pay this off before you negotiate. So negotiate it well, because they haven't gotten money from you. They may not get any money from you. It may be it's getting closer to that 7th year that item will fall off your credit anyway. So it behooves them to accept your payment instead of not getting any money. Okay, so you want to keep that account. We talked about when you make a payment on an account that was an old account, you now make it current because they have to report that you just paid it. The minute you do that, you actually made this fresh. It will lower your score. That is not in your benefit. Don't do that. Okay. So you want to get a dilution letter. And so the next item, the next thing you can do to increase your credit score, pay down your debt, pay off one loan at a time. Pick the loan. You don't want to start paying multiple loans simultaneously. Focus on a less efficient loan and paying down one first. Okay, this will minimize the amount of time it takes to get out of debt. So what you do, some loans are more efficient. So you don't want to pay a loan that's like a 4% loan or a 2% loan. You want to attack the loans that are affecting you the most, where you're paying the most interest. Once you have those taken care of, the more efficient loans will be more beneficial for you. Okay. So you want to keep the accounts a lower interest rate. And so, to close on this chapter, there's more to talk about, but better interest rate will save you a lot of money because you will make lower car payments, lower credit card payments. You will have better car insurance. You have better life insurance, home loans. And recently, some employers are checking, like people that work for the casino, with gaming licenses, they're checking your credit, or if you're a financial advisor. If you have a derogatory account reported to your credit, you can actually lose your job. So keeping a great credit score is vital. It's so important. I cannot overstate this. So that's really something to work on as a business owner, and it's a very big way to save yourself some money. When you have a better credit score, it allows you to be approved for loans that you might not otherwise qualify for. For instance, loans that we provide, SBA loans, you can get really favorable rates, whether it's for equipment or it's for marketing. Money is the fuel that you need to drive the engine that is your business. So it's important to have very good credit. So to summarize, increasing your credit score is just not about saving money, but it's about being able to reinvest the money that you get from, that you get to save from the interest that you used to pay, that you can now invest in your business and being able to, it's really can massively improve, let's say, your financial picture. So really, really important. If you want to do it yourself, there is a site that I'm working on. We'll be launching soon. It'll be credit repair classes, or you can go to creditrepairclasses.bizbank.com. It's not available yet, but it will be soon. I will let you know. if you are on this call, I will let you know, or this call, webinar, I will let you know when this goes up. You will have a ton of information that would help you. And this is all, I'm doing this for all of our clients, and it's free, to access the information online. If you'd like to sign up for one of our credit repair classes, I have one coming up May 15th, 2015. It'll be in Los Angeles at, by the airports. If you have any questions about that, you have my email. Feel free to reach out. I'll be more than happy to help you. If you need help getting your credit fixed, you just don't have the time. I mean, if you have the time, by all means, go for it. Really, if you have the time and you have the tenacity and you're willing to go back and forth with, with the credit bureaus, go for it. And, and if you need some help, you need someone to help you fix your credit, visit badcreditdoctors.com. They will help you with that. I made a special deal for you, for all my, for all the BizBank customers or people on my list, or just, if you're on this webinar or someone sent you to this webinar, they're making an offer right now for $115 to start, $89 a month. There's no contract. You stop anytime. Satisfaction guarantee. You can contact them. They'll work with you. I'm actually, whoops, let me go back here. I'm actually I sit on the board of this company. I'm advising the young lady who started this company, and I'll be more than happy to help you with if you have any questions. So if you have any questions, I believe there's on your board, there are, you can click on questions and you can ask me any questions you have, and I'll be more than happy to answer your questions. If not, let me know. We can, we can talk later. You can reach out to me by phone or by email. I'm available to speak with you anytime you like. So I'm waiting for your questions. Okay. So if there are no questions, I think we kind of went through this quickly. I thought it would really take a little more than an hour. We're just about maybe 13 minutes, under an hour. I just want to thank you for being on this webinar. If you have any questions, feel free to give me a call. Thank you, and you have yourself a wonderful evening.